Well, let's talk about Credit Suisse Asia Pacific strategy this time around. We tend to always get you what's happening with the India strategy as Neelkant Mishra keeps writing, but this time around we are focusing in on the APAC strategy. Now, there are some interesting Asia Pacific changes that have happened. Firstly, China and Thailand have been downgraded to a market weight. They were overweight earlier, and India and Australia have been upgraded to a market weight. Now, what their recent Asia Pacific strategy suggests is that they are advising their clients to go away from China or reduce weightage in China as well as Thailand, go ahead and put that money into India as well as the Australian market. That, according to them, are one of the key markets that can actually do well. Now, when we talk about China, why they are saying, or the reason that they are citing, is that they believe that the best in terms of recovery trade is now behind, and that's why they believe that valuations are full, and on that reason they believe that one should probably look at China now being a market weight versus an overweight rating that was there earlier. Now, when we talk about India, it's an interesting one. They believe that this year will be a normalized year as far as India production levels are concerned. EPS upgrades have started to happen right from the month of June, that is the June ending quarter Q1 of this year, and they believe that that is something which will continue, that will continue to re-rate as far as markets go. They have also spoken about the sort of COVID cases that are not coming back, COVID cases from the peak which have fallen quite significantly, and they in their base case are not assuming that there will be a resurgence of COVID cases here back in India. Now, when they talk about India and particularly why they like it, so credit to GDP ratio is the weakest as far as Indian markets is concerned, and that is something which they have particularly spoken about. On the other hand, they do not really expect any major NPA changes to some of the ongoing issues in terms of banks. Banks are well capitalized, and that is also one key reason to look at the Indian markets. EPS upgrades have happened, but they believe that India is in a sweet spot. India and Australia put together are one of the best when you just look at the Asia Pacific strategy. Now, it's not that they were underweight on India earlier, they were market weight on India, but now they have become overweight, saying that EPS upgrades is something which have happened, will continue to happen. NPAs or bad loans will be lower than what the street has been anticipating. Sufficient capital buffer has taken place, and they believe that RBI particularly, or the central bank of both India and Australia, where rates are not close to zero, they believe that they have sufficient room to go ahead and cut rates as well. They are not expecting CPI to bounce back quite significantly. Yes, people are talking about commodity-led inflation, but they believe in their base case that CPI will not see a rush than what is anticipated at this point of time, and also they believe that Indian markets will see a recovery led by EPS upgrades. It's a pure EPS upgrades call, with central bank having the firepower to cut rates even going ahead from here on, and that's why this tactical strategy is what they would call at Asia Pacific. China and Thailand are now market weight versus overweight earlier. India and Australia, which were market weight earlier, are now overweight in their portfolio.